Hey, I'm Kritika and I'll be taking you through commercial banking. Now to begin with, we have commercial banking, we have the introduction, which is banking in India. It starts off with the Vedic period where banking became famous by lending out credit. And then the next part was in 1771, where the first European Bank of Hindustan was set up. Next we have the Imperial Bank of India Act, which was passed in 1920, under which three presidency banks came together, that is the Bank of Madras, Bombay and a saving bank account. It basically caters to the middle income group. It restricts withdrawal in terms of amount of cash that is withdrawn as well as the number of withdrawals. It pays an interest of 4.5% per annum but is regulated by the RBI. The minimum deposit requirement is ₹100 and the account provides check facilities. The next deposit is the current deposit account or the demand deposit account. It caters to businessmen and traders. It charges a commission for the services provided. No interest is paid on this account. No restrictions on the number of withdrawals or deposits the recurring deposit account, it caters to people with regular monthly incomes. It requires the regular depositing of money and interest is paid on this account. Fixed deposit account, this account is the most profitable to the banker as it enables the bank to provide for long-term investments. This account can be withdrawn only after the expiry of a fixed period of time. The interest paid depends upon two factors, the amount deposited and the period of time that the money can be deposited for. The interest is either paid after the expiry of the fixed time period or in intervals or in monthly intervals. That is the fixed deposit account. Okay, now under general utility services, it provides foreign exchange, it provides underwriting facilities, bills of exchange, issues travelers checks, provides credit and debit cards, provides locker system, also plays the role of an advisor. Agency services, it collects receipts from the customer like interest on investment and rent received. It also pays off receipts, that would be bills like. Under types of banking, we have two types of banking on the basis of system and on the basis of structure. They're divided. Now under the basis of system, you have pure banking. Now the characteristics of pure banking are that it provides only short-term loans of less than a year. It accepts deposits from the public. It lends to industry and commerce, and the British follow this form of banking. The advantages is that it provides safety and liquidity to deposits and reduces risk of lending. It caters to working capital requirements. And then you have mixed banking system where the characteristics are it provides both long and short-term loans. It accepts deposits of public. Short-term and long-term loans of industry is provided by this type of banking system. The Germans use this kind of banking, and the principle that it works on is that it looks to mobilize funds of the public. Okay, so advantages are that it is very knowledgeable of the industry, it enables industrial development, it advises and provides guidelines for industry, and it also ensures public safety. Disadvantages of mixed banking is that it has greater risk because it provides long-term loans, it reduces liquidity, and it also proves a threat to commercial banks. Now on the basis of structure, you have branch banking, unit banking system, group banking, correspondent banking system, and chain banking. Now under branch banking, the basic characteristics is that it has a number of branches. It has one board of directors and it has one group of shareholders, and this type of banking is followed in India and England. Now the advantages is that it has economy of large scale operations, economy of cash reserves, remittance facilities, spreading of risk, and it also has mobilization of deposits, diversification of deposits and assets, efficiency in management, economy in working, and effective control by the central bank. The disadvantages is that it needs to consult with the lead office for every transaction that it makes. There is a transfer of managers. Funds are sometimes used inadequately, and non-profitable branches have to be borne. Also, the management is expensive, and there is a possibility of monopoly. The next banking system is that of the unit banking system. Now the characteristics is that it's an individual bank, it has limited resources, it is confined to a particular area, and it works on a small scale. Now the advantages is that it has effective management and supervision, it has a knowledge of local industries, it checks on the formation of monopoly, it is a fast banking service, and it caters to local needs. The disadvantages is that it has inequality in the interest rates that are provided, inability to finance large-scale operations, lack of diversification of funds, higher cost of remittance, inability to face financial risk, and it yields to influence and pressures. Okay. And then we have something called the group banking. The characteristics being that it has two or more separate banks under one holding company, and it has centralized management. Both banking and non-banking form part of group banking, and each unit has a separate legal entity. Now under chain banking, it is also has a common control of a holding company of two or more banks under a device under a device which can be either group of directors or a group of persons. Under group banking, every unit of bank or every unit bank is also recognized as a separate legal entity. Now correspondent banking system is where small town banks are linked to bigger banks. This enables small town banks to provide better services and facilities. Okay, then moving on to India and commercial banking in India. Under that, the most important is that of the commercial bank's investment policy or the lending policy. This basically deals with the techniques and methods of investment, especially investment of the deposits is a difficult and risky task, and hence it requires a lot of investment. Now banks invest a considerable amount of the funds in government and industrial securities. In India, commercial banks are required by statute to invest a good portion of the funds in government and other approved securities. Certain guiding principles in investment policy are liquidity, profitability and security. This led to nationalization of commercial banks and banking system in India, which basically had the reasons for nationalization was that there was ownership and control in a few hands only. Then it led to failure of mobilization of resources. Then neglect of small business units and agricultural sector. And the 5-year plans that was decided by the government really did not work. And there was a concentration of wealth and power in a few hands only. And the resources were utilized by directors, which was not acceptable. And there was a misuse of bank funds. Okay, so after nationalization, the effects were as follows. This enabled branch expansion, which enabled better utilization of deposits. There was an increase in banking habit of people. There was a change in banking policy, and there was a shift in lending system of priority sectors. Also under social banking, there was core banking solutions were available. Also integrated rural development programs were started, and differential interest rates were provided. Also foreign banks in India were allowed, and offshore banking was also let in. Under diversification of banking, you have merchant banking and underwriting, also factoring services, mutual funds, venture capital, housing finance, equipment leasing, and technological developments in banks. Okay, now coming back to commercial banking and under India. Now the banking system in India has these following banks as its part of its system. Now you have private banks, you have commercial banks, the scheduled and non-scheduled banks, you have foreign banks, you have merchant banks, and you have the SBI, which is the State Bank of India and its associates. Now the major subsidiaries of the State Bank of India are Travancore, Bikaner, Patiala, Indore, Saurashtra, Hyderabad and Mysore. Now the objectives of State Bank of India is to extend facilities to the rural and suburban sectors of India and provide financial help in terms of marketing societies and warehousing. Also to provide to cater to the credit needs of the rural and small scale industries. Okay, and finally we're going to talk about the assets structure of banks in India. Now that assets structure of banks in India follows section 11 of the Act of 1949, and it also extends its control of the share capital. It requires the declaration of dividends of its reserve funds and the deposits of the commercial banks. Also on the asset side of the balance sheet, a certain particular assets are to be declared. That is the current assets, which include cash in hand and cash at bank, the bills receivable, the fixed assets of the commercial banks, as well as the investments, and most importantly the money at call and short notice. Okay, that's it about commercial banking. I hope it has been of use. Thank you. Bye-bye.